Hi, my name is Greg Hansen. I'm the Managing Director of Trust Investments for Legacy Private Trust. And with me today is Connor O'Brien. Connor is one of our portfolio managers. We're going to give you an update on the markets and the economy, as well as some thoughts that we have on the Fed for our June 2021 call. Kick it off, and Connor, like I said, we'll talk about the markets and the economy, look at year-to-date performance and what we're seeing in the job and inflation markets and front. And then I'll talk about the Federal Reserve and what their likely course of action is going to be as a result of what we're seeing out there. So with that, I'll turn it over to Connor to kick it into the markets and economy.
Thanks, Greg. So flipping to slide 4. So what we're looking at here is year-to-date performance for some of the major indices on the right in black, as well as from an S&P 500 sector perspective on the left in blue. And I wrote a little bit about this in an earnings piece I put out last week on the website. When you look at what's worked so far this year from a performance standpoint, it follows the economic recovery playbook pretty much to a T. As an economy bottoms out after a recession, you would expect the industries and the companies that are the most cyclically sensitive to perform better, just as you would expect those same industries and companies to perform worse in an economic downturn. So that's exactly what we're seeing. Sectors like energy, financials, materials, real estate, industrials, those are all doing really, really well. And then the sectors that are less cyclically sensitive, those that would do well irregardless of economic activity, stuff like technology, healthcare, consumer staples, utilities, those sectors are all underperforming. The only outlier when you look at this page is consumer discretionary, which is on the far left-hand side of the page there. The reason for that being that sector is mostly made up of really two companies, Amazon, which a lot of people could argue is essentially a technology company, and Tesla, which has its own long list of idiosyncratic risks as well. It's a similar story when you look at the S&P 500, which is a large cap index, versus the Russell 2000, which is a small and mid cap index. Smaller companies are obviously a lot more reliant on a strong economy, and you would expect them to have better performance during economic rebounds. Foreign developed markets have traded right alongside the S&P 500 year to date, and emerging markets have lagged a bit as their economies have been a bit slower when it comes to vaccine rollouts. Moving on to slide 4, slide 5. So there's an employment theme that's starting to emerge, and it really started last month with the April jobs report, and it continued this month with the May jobs report that came out last Friday. And the theme is that we may have been a bit too optimistic with our employment projections so far this year. We're finding that it's a lot harder to let people go, or a lot harder to hire people than it is to let them go. And we're seeing that play out in a couple less than stellar jobs numbers over the last 2 months. The chart on the left-hand side of the page here shows that there's still a 7 million jobs hole that needs to be filled to get us back to pre-COVID employment. And the chart on the right shows the industries that where those losses and subsequent gains are concentrated in. And as you'd expect, the leisure and hospitality industry sticks out. We still have a long ways to go before hiring is back to pre-pandemic levels in leisure and hospitality. The latest jobs number that I had referenced a few minutes ago from the past month are on the right-hand side of the page. The unemployment rate is down to 5.8% after hitting almost 15% last year. We added 559,000 jobs compared to consensus estimate of 650,000 jobs last month. And the labor force participation ratio ticked down to 61.6, which is still well below the participation ratio that was 63.3% before COVID. So very solid absolute employment numbers, but relative to expectations, we've come up short. The last slide that I'll take is slide 6. So inflation is a big buzzword right now. We've had one of the hottest CPI readings in years last month, and actually we had another big print this morning. We did want to clarify that these prints were fully expected. We knew that the economy reopening, with us comparing prices to what was a very deflationary period a year ago, we knew that we were going to get big bumps in inflation this year. The main question we have now is whether or not this inflation is going to be transitory or temporary, or whether we're entering some sort of sustained or permanent rise in prices. And Greg is going to talk a little bit more about specifically what the Fed is looking for. But in general, we will be looking for some sort of sustained overshoot of inflation before they even consider raising rates. You know, not 1 month of inflation, not 2 months, but sustained higher prices across a broad array of categories. A few years ago, the Fed set a target of 2% inflation, or an average of 2% inflation for an extended period of time. And because COVID was such a huge deflationary shock to the system, we still have lots of catching up to do before we get back to that pre-pandemic target. This chart here looks at CPI since the beginning of 2018, which is a common index of prices. And as you can see, the last few months we've seen inflation pick up. That's that black and teal line there at the bottom. But we still have a ways to go before prices catch up to the pre-pandemic CPI targets that the Fed set out. And we have even further to go before we get to the level that would fall in line with their goal of targeting an average inflation rate of around 2%. So speaking of the Fed, that's a good segue to Greg, and I'll pass it back to you to go over that.
Sounds good. Thanks, Connor. As we talk about the Fed, we're having conversations with clients, and a lot of people are focusing on the near-term data, the inflation metrics that Connor was referencing and how quickly that's heating up, and starting to talk about what action the Fed is likely to take or needs to take. In our estimation, at this point in time, the Fed can be patient. We've hinted at that in the last couple of months, but again, we're saying the same thing here. Really two different tools that the Fed has at their disposal. The first one is represented by the blue line, and that's the total balance sheet. And as you're aware, right now they're buying $120 billion of securities every month. So the balance sheet continues to expand. The first thing we think they're likely to do is reduce the pace of those purchases. So if and when inflation picks up in the economy, assuming it continues on the course that it has been, if that continues to move in that direction, they would likely reduce the pace of their purchases. But when you look at 120 billion per month, that's 1.44 trillion per year that they're expanding their balance sheet. So there's a lot they can do in that regard alone, just to take their foot off the accelerator before they really start to move in a fashion that's going to cause contraction within the economy. The second tool, and what we think that would be pretty far down the road before they would actually use, is the Fed funds target rate. As you can see right now, that's down at the red line at the bottom, and it's essentially in a range between 0 and 0.25%. It's been there since March of last year, and we really don't see that moving anytime soon. As far as the Fed's tapering, this is a piece put out by Goldman Sachs, and it just outlines what it might look like if the Fed were to start tapering asset purchases. First half of 2021, not expecting to see much in that regard. Second half, they're going to start talking about it. There's a big event in Jackson Hole, Wyoming in August. It's an annual event that they host out there. And that's usually where they will start to talk about policy changes that are likely to be upcoming. Big thing here is that they don't want to shock the markets. So they aren't going to just put something in place overnight and start acting on it. They'll start talking about it before they implement it. And then maybe first half of 2021 or 2022, or throughout the entire year of 2022, they would start tapering 15 billion per Fed meeting. And those meetings come up about every 6 weeks or so. And then into the first half of 2023, they may pause to see how their tapering is going. But if you think about that, they're still not shrinking their balance sheet. They're not putting these securities back into their market. They've just stopped making purchases at that point in time. So the balance sheet is still going to be well in excess of $8 or $9 trillion as it is today, plus any continued purchases that they make. And then finally, 2023, maybe we'll see some rate hikes in the second half of that year if economic expansion continues and growth continues at the current pace, and they feel they need to slow down the economy. But a lot can happen between now and 2023, so we're not making an absolute forecast there. We're just saying that it's likely that far off before we would start to see much in terms of interest rate policy coming into play. In terms of what the Fed is watching, we know they have a dual mandate. You'll hear some things from time to time that may make it sound like they have more than two objectives, but In their charter, it's really back to these two particular items that you see on the screen here. Unemployment rate, so they want to have full employment. And just based on where we were pre-pandemic, you can see that we're at an unemployment rate of 5.8% now. We're not back to those levels. We still have a ways to go, and we think this is going to take some time to play out. When you think about the number of states that have extended unemployment benefits on the table yet, I believe it's 22 or 23 states that have now withdrawn those, but there's still a majority of the states that are paying extended unemployment benefits for a period of time yet. And when people can make more staying at home than they can going to work, there's not a lot of incentive for them to go back and rejoin the labor market. So as those extended unemployment benefits fade, we will expect to see more people coming into the labor market. But remember, they also have large amounts of stimulus payments that they've received over the last year and a half. And a lot of people have those in savings. So that may further delay the return to the labor force for some people. The other side of the Fed's metrics that they're watching comes in terms of inflation. And Connor commented on the CPI, Consumer Price Index. What we're looking at here is the personal consumption expenditures. This is another metric that the Fed uses. This is actually, as they've said, their preferred metric. Both measure inflation a little bit differently. I think the takeaway here is that you are seeing inflation rise and rather dramatically over the last year. But again, we haven't seen a sustained period in that 2 to 3% range, as he was saying. And the Fed is likely to err on the side of letting inflation run too hot. They've been trying to get inflation restarted since 2008 unsuccessfully. So it's unlikely in our estimation that they're going to try to shut down inflation as soon as they start to see signs of it. And then the last piece of the puzzle here in our view is what the Fed is saying versus what the markets are telling the Fed. So if we go back to the Fed funds target rate, and what the Fed is saying is captured in the dot plot, as it's been called. And so basically the Fed members are forecasting where rates will be at the end of 2021, 2022, 2023, and then longer term. And as you can see, 2021, nobody's forecasting a change in rates there. By the end of 2022, of the 17 members, you see 4 that are starting to hint that maybe there'll be a little bit of an increase, or maybe there's a 5th dot in there, but the majority are saying no increases in rates yet in 2022. And you do get a few more that are saying by the end of 2023, but that's still more than 2 years away before you're really starting to see much. And the majority of the voting members on the Fed are saying that it won't even happen by the end of 2023. What the market is telling us, which is the white line, this is coming in from the Fed funds futures market. Market is telling us, Fed, we agree with you for 2021. We're probably not too far apart in 2022. And then opinions start to diverge as we get into 2023. So that's something that we'll continue to watch. If the market starts to anticipate rate hikes from the Fed sooner than the Fed is ready, the Fed may have to change their language and their tone, in which case that could lead to a little unsettled action in the markets in terms of fixed income rates. The other thing that could happen is the markets could reassess things if the economy doesn't pick up at the level the Fed is anticipating, and the markets could start to come down closer to where the Fed is. But I think the big takeaway here, again, either way, we're probably about 2 years out, 2.5 years before we really start to see much movement on the interest rate front. And long before we see that, we would anticipate seeing a tapering in the purchases on the Fed's balance sheet. So with that, we'll wrap up. Thank you for joining us today. If you'd like any more information on Legacy Private Trust Company, please contact marketing@lptrust.com.